Alright, hello guys, and glad to have you on board again. Today we finally had that very much expected monetary policy meeting with the Federal Reserve Board Committee, and it has been definitely an interesting one to look for. So we're going to unpack what has been said out of it. I'm calling this one a 2022 update. The Fed finally bringing us a roadmap, because that's definitely what I think has happened. So we're going to decrypt that, what this roadmap looks like, what it's going to be, how uncertainty still remains definitely at play. So this is kind of a roadmap that I will follow until it actually ends up being proven wrong or something else, because of course nothing is ever for granted. We did receive a little bit of a guideline kind of mission from the Fed. At least now we have one thing: visibility, and therefore this is what we're going to discuss about today. What this visibility is, what we expect from the next few months, how likely these things are going to be validated or not, what it impacts on the future, and all of these very important things. So let's get started. It's going to be a long thing. I think 30 to 40 minutes is what I ended up with for the French guys, so expect pretty much the same with you in English. Okay, so first things first, talking about the federal funds rate. We did get the 0.5 increase, so 50 basis points. That's definitely what the market was expecting anyway. So what the market was paying a lot of attention to was definitely not these 50 basis points, but most importantly, what's next? How many, how much, how far? This was the question that the market was willing to get, and we actually have those answers. What I like is the fact that generally JJ Powell keeps on this blurry type of press conference stuff, and then of course the journalists ask the true questions, trying to get the hidden answers. What I like from this one is that first and foremost, that's since COVID, so we finally had Chairman Powell in person in the press conference room, so that was good to see him. Way better for me personally to look at all the non-verbal communications and things like that, because we had high definition cameras and stuff like that. So this is very useful. But most importantly, for a little once in a while, we didn't have to really look behind the surface, trying to find some hidden clues or stuff like that. The communication has been, for once, very clear and neat. We didn't really had to wait for the question series to actually get the hidden details. It came up really straightforward with everything the market was waiting for. So I would say good point, and very good press conference from Jerome Powell. You guys know that I had some concerns regarding the past ones and the mistakes that the Fed had, specifically by the end of last year. Well, I would say JJ Powell is on the top of the art for this one. So just like I am here pointing out the problems, I also am the ones who point out when the good things show up. So very thumbs up from this one. Very goodly and very well managed communication for JJ on this one. So still, let's talk about the real deal. So 0.5 or 50 basis points, and what we got straightforward from the press conference is that we might expect another couple or three another 0.5 increase. That was the major thing. The second thing is that this one comes from the questions, but it's been said very much straightforward. I mean, shoulders open, really very nice nonverbal communication at that point. It really wasn't these doubtful kind of, we don't know necessarily, we still want to keep shaded gray areas, projections of these things. So not at all. This one was totally assumed and very well presented. And he said very clearly, two another rate hikes are guaranteed. The third one is very likely as well. And the important hidden factor, not very well hidden anyway, was that when the journalists asked the questions about market pricings, normally JJ Powell never answers such kinds of questions, but it clearly answered this one, saying that, well, of course, we don't comment on market pricings and stuff like that, but when it comes to bond, he said very clearly, I think the market has very well anticipated our guidelines. So he congratulated himself, saying that the Fed has done a good job because for some reasons, even though it was pretty messy out there in terms of communication and so on, the market still somehow find its way into understanding the projections for the Fed. So some people will say this is kind of a rollback out of the transitory argument and the bullshit that we've experienced previously, and I would agree with that. But still, the core information is this. JJ said the market is correctly anticipating the Fed's targets. So the Fed targets, he says, is between 2 to 3% target interest rates. The market was at the end, during the press conference, pricing at 3%. So there's one thing that really, I think, has been said, pretty much hidden below the surface, but not very far beneath. It's that, well, we're pretty much at the higher end of these targets, 3%. And these are the market's expectations, and I definitely think that we're going to top up above these levels, but I'll explain afterwards. Why is that? Well, the Fed's target, I think, is between 2 to 3%. That's what they say, but I think it's going to be slightly shifted higher for many, many reasons. The first one is that I'm not supposed to do technical analysis on such charts over the historical Fed funds, but, well, it turns out it still works, so I'm going to use it. It's better than nothing. So in terms of things, I think the end of this endless thing of 50 years decreasing interest rates, very long thing, I mean, we really have gone down to the bottom of it. So I think that anyhow and anyway, we're going to have to rise the Fed funds rate above what we were trading in 2019. So we're going to have to go above it. So when the Fed says between 2 to 3%, I think it's not nearly the case. I think 3% is the current market anticipation. And of course, there's going to be a bit of volatility out of speculations and stuff like that. So I think we're going to overshoot over 3%. 3% kind of being the mean target for the Fed, very likely going to have to be raised slightly, but I explain about that. So the thing is that I think bare minimum is 2.5%. Remember that the Fed's rate is a target rate of 25 basis points. So the Fed target rate should be at least between 2.5 and 2.75. But to be honest, I think we're going to go higher than that. So when they say 3% is the current actual true market projections, and we agree with that, I think that's the minimum we'll get. So I think 3% is going to be the support for the next plateau. Okay, we're going to get another plateau. The thing is that, of course, there is a big other factor that has been repeated multiple times as a verbal expression. We finally got out of this stupid bullshit transitory thing, and now the new thing now is preemptively. So we're going to rise interest rates preemptively to bring back inflation under control. So this is really the new motive. They're going to do quick, and they're really going to catch up with inflation, and they want the long-term or mid-term inflation expectation. The Fed is generally using 6-month expectations of their inflation swaps, and in that perspective, they expect the targets of both the rates and the 6-month projected inflation swaps to kind of meet together. That's what they want. So let me be real clear. The current inflation measurement is absolute bullshit, of course, but still, that's what they look for. They want these two to bring up together. So they want inflation to cool down and to meet with interest rates, not the reverse course. That means we're never going to get inflation below the target interest rates, but what they want is for them to be in the nearby area. How wide is the very much interesting question that we should ask ourselves? I personally think that a 1% spread between the two is what they will consider acceptable. So I don't nearly think inflation is going to drive anywhere below 5% or 5.5%. So I think that these 3.5% target for interest rates seems to be an appropriate, acceptable target for rates and inflation to kind of meet together in terms of projections. So that's the area in which we should get down to. The things that we'll never get to, I think, is breaking this one. So I think, know that there's not going to be an overshoot up to 5%. So it has to go above 2.75, but I think we're going to overshoot that, of course. And we hardly going to get above 5% until things changes. And we have to assess that very importantly. Things could change. We're in an environment in which we're prone to chaos, to external environmental factors to just come and fuck it all up, whether that is environmental pressure or wars and all of these things that could show up. We're in a dangerous corner, so don't think we cannot go above these levels. It just means that without further disruptions, we should stick between those two levels. We cannot sustain 2.5, but we cannot go right up to 5%. So something in between, like I said, 3.5 is like a reasonable target. So how do we get there? Because that's what the market was looking for. So as we said, we got a 50 basis points increase, and we expect at least a couple, and I think 3 others are to be mandatorily coming along with it. So we're currently trading 0.75 to 1% target interest rates. So if we want to go at 2%, or 2.25, which is the bare minimum, okay, so retracing to the previous plateau is requiring 3 more interest rate hikes. We're going to get these. So I think we're probably going to get a 4th one behind that. That will lead us into the target area around 3%, which is the current market expectation. But as always, the market will anticipate. So the market is currently trading around these 3%. And don't get me wrong, we're probably going to overshoot over that target. The question is how far, because I doubt we'll get right up to 4%. And we're going to look at the charts to kind of give a bit more details on these markets projections and the actual viable targets for this. But the thing is that these preemptively argument means that we're definitely not going to get something like that. We're going to overshoot over the previous thing, and we're probably going to do it quick. We're going to do it into the shape of the next 3 to 4 months, and then there's going to be a first shift. Because there is not just interest rates in the monetary policy that the Fed can adjust. And they've said, well, we're probably, and that's what I think they kind of hidden, but not very well hidden anyway, it was in plain sight, is that we're probably going to terminate the 50 basis points hike, but keep on doing 25 basis points to adjust the target interest rates up to the market expectation and up to inflation projections. So first we move up, we move quick, we move preemptively until we break the long-term trend, and then we adjust at sight. And that's what I think is the smartest choice to make if we want to go for a soft landing. Though, of course, don't get me wrong, if it ever is going to succeed or not depends on external, out of their control factors. So, if the Fed is lucky and if nothing comes putting shit in the fan, normally things should do well. So they do it in the 2 sets of timings. The first one has been started, and we're probably going to last until 3 to 4 months from now. Additional 50 basis points rate hikes, bringing yields to terminate that long-term bullshit trend, and then fine-tuning. Okay, for how long? Well, like I said, it mostly depends on market expectation, because the Fed is definitely going to look at the market. That's the new message. They're going to look at the bond market. So I expect volatility out there, but I also expect that we're pretty much reaching the target. That's the second message. The targets for the Fed have already been met. So they expect probably to overshoot a bit as the market will be nervous, but still we are pretty much nearing the target rather than being in the beginning of a long-term trend. So this is what the real message was. We're going to get a plateau, and we're going to look for fine-tuning until we get that plateau. So how many 25 basis points rate hikes are we going to get beyond the 50 basis points fast track is the actual true question. They said, or somehow let us believe, that it's very likely going to be adjusted according to the second step of that thing, which is the balance sheet sector. So in terms of balance sheet, they've announced one very clear thing, is that we're going to get 3 months testing kind of going easy with the market, just $30 billion of treasury bonds sold per month with a cap. So that means this is the maximum we'll get up to, and that doesn't mean we're going to reach these. We just have a maximum cap. And we're going to go $17 billion of mortgage-backed securities. So in that perspective, that's a kind of a top-ish kind of thing. We're going to stop increasing and we start decreasing slowly for a few months, and then after 3 months we're going to double it up to a couple $100 billion of both mortgage-backed securities and $60 billion of bonds of different maturities. They're going to sell the short-term maturities first, as I said. So it's going to accelerate. We're going to get from 50 billions for a few months until we get to 100 billions per month. So it is easy because, as well, I said we're not supposed to do technical analysis over these areas, but there's basically $2 trillion of spread in between this, which is the post-COVID era, the post-crisis era, and the support to the economy. I think this is what's going to be erased, so we're probably going to get back there. So there's $2 trillion to erase at a pace of $150 billion in the first month. We expect up to 2 years to get there. So we're starting to see a roadmap that is leading us up to 2 years. So it's going to take 2 years to get back there, and then we're very likely not going to go below that. So this is, I think, the evidence that it is not said exactly this way, but it's really hinted that way, that we're going to do a two-step kind of sequence in which, first of all, we raise hikes, we hike interest rate pretty quickly in a 50 basis points manner, and we're not expected to go further than that unless there are severe changes on the inflation projections. So it's going to be a set of 50 basis points each month, so it's going to be quick. And then we go for a few sets of 25 basis points, and eventually, further down the road, we'll keep on 25 basis points, but with longer terms directions between them. So we're going to let a few months to pass between separated 25 basis points. So we do this kind of soft lending fee rates until we find a plateau. Like we said, they're going to follow market projections and try to come up with these, as long as they're going to follow 6-month inflation swaps, and they want these two to be in a 1% spread in between. Okay, so they want inflation likely going to be higher, and they want a spread of less than 1% between the two 6-month inflation projections and actual Fed funds rate. Okay. And in terms of balance sheet, we're going to get the same thing. First, we go easy for the first few months. Then we go harder, and we maintain that pressure over time as we keep on pressuring, but we remove slowly but steadily the increase on interest rate until we find balance. And we let that thing go on for 2 years until we retrace to post-crisis levels. And in that perspective, the balance sheet we're very likely going to be maintained flat, because don't expect these things to ever be retraced. Okay? So that is the roadmap. So there is a 3 to 4 month increase with limited testing on the mortgage and bonds selling. And we're going to sell short-term maturities first to kind of test the market's reaction. We don't go too aggressive on releasing what we bought. Then we slow down on the interest rate cycle. And in that perspective, we start increasing longer-term maturities testing, and we start releasing more of the balance sheet on a month-to-month basis. And then, of course, as we adjust and as time passes, we try to fine-tune on the rate hand, and we maintain depression. And they, of course, said we're going to eventually increase or decrease, but they said it's very likely going to be linear in terms of balance sheet regression. And as we've seen from the past, this is definitely a logical thing to do. So it's going to be a fast decrease, much faster than we've seen previously. But of course, like we said, this is going to be preemptively. The Fed is going to be aggressive because they definitely have been behind the curve. Even though they don't mention it, that's really what happened. So you have to understand this cycle. This is the new information that we wanted. It's bringing us a lot of information. The first one is that it's been a very, very long time since the Fed has been that clear about their expectations. Because they finally said, I think the market is doing well with expecting. So finally, we at least have a bracket in which we can work. So we have definitely good expectation. The first information is that the market very much have anticipated most of it. So the Fed was late and behind the curve, and the market did well trading somehow against the Fed, but they did well in projecting what the Fed is now going to come up to. So the Fed is going to come up to the market expectation. So the second message is the market is pretty damn very well nearing the target rather than starting a trend. So everyone who's talking about a trend now, that yields are increasing, the inflation is rising and surging out of control, euro dollar is crashing, whatever, bullshit. We're pretty much in the target areas. So the market's expectations, there could be a little bit of noise now, but we're pretty much at the area B. Remember that trends move on value areas from area A, in which we start, from area B, in which we terminate, and range. So there is a very likely probability, and the Fed, who's normally never commenting on such a thing, kind of give us the confirmation that the traders wanted. We trended early against all odds, and mostly against the Fed narrative, but now they say, well, you were right, and you are in the right spot. So that's what I think is a very good message for the market. Your anticipations were correctly plotted. Now we're just going to meet them. And that's a very good message because it brings us two things, a roadmap and, more importantly, visibility, because we now know how they're going to come up to the market. Preemptively, yes, but still, that means we're already there. So in terms of market valuation, everyone who's calling for the crash or whatever, very less likely going to happen. Yes, we did have a kind of a rally rebound yesterday, and most of it is being erased as we speak, but still, understand that way, we are really, really almost in the target area. So there could be some overshoots, just like I think the interest rates are not yet there. The market, now that it says that the Fed is agreed with the market projection, the market was very likely going to overshoot. It's like a baby in a shopping center is just going to go crying everywhere trying to get whatever it is. So I expect volatility. Now that the market is correctly trading in the expectable target, the market is going to try getting more. So in that perspective, I suspect that the trajectory is still going to be volatile and slightly bearish tinted on the stock market. That doesn't mean the hell of the market is going to go down, because we're pretty much at the supportive area. Remember that. They're going to keep pressuring, I think, for the next 3 months, because we have that timeline, and that is the second very, very much important information from that press release. We've got a roadmap, but we've got a timeline, which is very great, associated with that thing. So 3 to 4 months from now is the fast pace of interest rates and slow pace of releasing the balance sheet. And in that thing, I don't think it's going to support the market. It's definitely not going to. The market may rebound on kind of euphoric behavior like yesterday and fall down right after and so on. It's going to be sentiment driven. I don't expect the sentiment to be bullish now in Wall Street. I still expect the sentiment to rebound out of the very under pressure areas we were into. Okay, so I suspect now the market is going to buy oversold territory, and what I would like to see is kind of building higher low points would be a good sign. Kind of the market remaining neutral in there, not going too crazily bullish. I would like to see it breaking on top of it and ranging, like going back to neutral with a bit of sentiment volatility, which will very likely be the driver, the main driver for big indices pricing. Because as usual, I think everything is happening under the surface of the indices. There's so much volatility on stocks themselves. Some sectors have been absolutely hammered where some others did not. So there is going to be a lot of rotation, I think, in indices. So trade the indices is not going to be an easy task. It's going to be volatile, but I think it's still slightly bearish tainted because we had a bearish range context. So I think we're going to trade these bearish channels. And if I were to project these probabilities, I would say that we got a bit of a timeline, and at least currently that's the motive that I will personally follow. As usual, not financial advice. I just share what I do. I'm a trader, not an analyst, so I tell you what I do and you do whatever you want with that. I think that the current target rate is around the end of July to around October to around August. So I think this is where we're going to be, at the bottom of that trend channel. So I think that what we're left trading with is that I don't nearly think we're going to break this. I think we're going to test it again. So I think there's going to be some positive reaction at some point. That's very likely going to try overshooting that trend channel, eventually slowing it down a bit. But I don't think it's going to be that big. It's just going to do changing a little bit of these things. It's not going to be a big changer. Though I think we're not going to succeed trading on top of this trend channel. And if we do, then it's just going to slightly change the pace. But still, I expect these targets to be met. This is where we had major support. So I think this one could be a target if we, for some reasons, try to succeed changing the pace of that thing. Okay. Otherwise, I think this support could be targeted if we fail to ever change the current pace. So if we kind of flat range, and then I think at some point we're going to get deterioration, which will be the actual bottom and I'm willing to buy. So I think there is still some more losses to come in the stock market, but that's very much a sector dependent. And like I said, the weighting of indices are absolute bullshit. And I have maintained that rhetoric for months now. We're going to have to pay the consequences of it. The fact that big bubbles like Apple could burst and destroy billions of dollars of market caps, though these market caps dollars has to go somewhere else if we want the indices to maintain their valuation. So even though it's going to be slightly bearish tainted, I think there are lots of big stocks that can take a hit, hard hit. They're not going to die, they're just going to suffer a bit. And this money can be absorbed somewhere else, an oversold sector like biotechs and gamings and stuff like that that have been hammered during that correction cycle. And they are very much ready to take on capital. But I don't think they're going to be enough to absorb everything. So it's slightly bearish tainted thing. But like we said, we're trading currently at the 50% line of that thing. So don't be too bearish, just like don't be too bullish. I think it's really going to be neutral sentiment in here, but I still think at some point some shit could hit the fan on stocks. So if I were to buy an indices or any indices, I would wait longer in time, but I will also wait slower and lower in terms of actual pricings. Otherwise, I keep trading my portfolio, buying some oversold assets that could rebound. They're not going to trend anytime soon, and arbitraging by selling overbought assets because I think we're going to go back to normal. That's what the Fed wants, to bring back valuations in a more rational territory. That doesn't mean they want to crash it all out, okay? Is it going to be successful? Like I said, this all comes with risk limitations. Nothing can be forecasted for sure. Okay, so that's for stocks in general. Then we need to move on with the dollar and yields. So like we said, yields, if we have a look at volatility, because what we've seen in here is definitely a volatile move, the Fed has to move quick, so it's more a matter of volatility rather than actual value. But the message is the value is pretty much in the nearby targeted areas. So expect the market to overshoot. Like I said, 3.5% seemed like a rational target because this is where we find the volatility boundary on the higher time frames. So these are yearly Bollinger Bands, and I think that, these ones are quarterly Bollinger Bands, and I think they're very much going to be resistant. But they're oriented to the upside. So I think 3.5% is what the market is going to test, eventually overshoot to 3.75, but it's hardly going to be bigger than that. 2.5% is a mandatory support. Is it going to be tested? I don't know, but if it ever is, I'm going to buy it. So I think this is the range in which the markets will very likely going to oscillate until they find their top, and that's not necessarily going to be an immediate stuff. We still have the bullish momentum pushing forward, but understand that the message has been sent. We're pretty much in the value area. We're going to oscillate across. It's pretty much going to be volatile or not. It mostly depends on markets' expectations and uncertainties. But as I think that this press conference has brought us one thing, a bit of visibility, which is removing a portion of the current uncertainty in the market. So normally these things should create not nearly a Fed put, but what it should be doing is a volatility put, reducing volatility without necessarily changing course. I still think that we're definitely going to get higher lows and higher high points within the next first 3 to 4 months until we actually eventually change that pace and break the trends. So this is really the message. I think that until midsummer, we're going to get these motives in which things kind of bullish range, but they retrace deeply. We're going to start to get retracement, okay? It's not going to be the straight line thing that we've used to go. So I think we're going to consolidate, go bullish, consolidate, go bullish, consolidate, go bullish for 3 months, and then the reverse thing, like consolidating slowly on the opposite direction, looking for supports until we actually eventually get that soft landing in which we get a resistance and a support. So that's what I forecast for yield, but to be honest, that's exactly what I forecast for the dollar as well. I think we're going to try overshooting in this area because there is a lot of tension, but most importantly, there are some overseas currencies, and specifically the yuan, who is definitely undervalued or bringing the undervaluing perspective, so they'll keep on pushing very hard, and that could push up the dollar relative to other currencies without not necessarily fucking up the euro dollar, because I think this is going to be an absolutely important next 3 to 4 months, because now that we get a roadmap from the Fed, everyone is going to expect the same old roadmap to be delivered within the next quarter in the Fed, in the ECB's side. So I think the market is now going to wreck it all and destroy euro dollar. But I think, yes, overseas currencies and specifically Asian type currencies may eventually keep up the momentum, which could eventually keep pushing the Dixie into bullish territory. But I hardly think that the euro dollar is going to be under too much pressure. Some lower shadow candles eventually, but like I said, I don't expect a huge reversal on the euro dollar. We have no signs of it, but we're already trading far beyond those volatility boundaries. So I think we've gone a bit excessive in terms of euro dollar, and I think that we're never going to recover that support, at least not anytime soon, but I think we've already got the bottom, or we're pretty much nearing it. So I expect kind of a range going on in here, so I'm waiting for the market to confirm that to me. Until then, I do not have too much position on the euro dollar. I already have positions on this level, but, well, I'm not going to pile up new ones until I get at least validations of it. All of these exits pattern definitely tell me that, well, I don't think we're going to get that many of rebounds, pretty much like the hashing that we've had back then. But as we're far off the volatility boundaries, pay attention to eventually volatile rebounds. They're very likely going to be short-lived, in my personal opinion. But I expect kind of something like we've had in the COVID, but in a much less volatile perspective. But I expect this to be noisy and absolutely stupid. The other arbitrage that I had is still going on between silver and WTI, and I don't change anything with this thing. Like I said, the message that I took from it is you are actually projecting correctly. So, of course, the market is going to go irrational a bit more, but I think we're already in a target area. So I expect range to keep up doing in the USD WTI just like they are in silver. Of course, you can replace by another one, but you can see those ranges are already at play. So silver could eventually try to go for the volatility boundary, but that's pretty much all of it. There's not that room to the downside, and I expect anyway, sooner or later, silver is going to go to this upper volatility boundary, and that's going to be the next trade for the summer, I think. Finding the bottom, if we want to go to the volatility boundary, eventually we could do so. Otherwise, I think strong rebounds will definitely lead us to the volatility boundary, and here we're just going to open up through the next month. So I still think anyhow and anyway, even if the dollar has been strong, whatever, it's always going to benefit, I think, precious metals. Silver is my favorite due to the ratio between silver and gold, but of course, do your own research and do your own fucking trades. But my personal favorite is the arbitrage, meaning that when I buy silver, I profit take my short selling activity on WTI, and when this one goes too quickly upside, and when it enters the short selling territory on USD, oh boy, and we're actually getting through it. Shit. Okay. Damn it. Okay, so we're getting closer to it, slightly bit higher than that, but if we get to this area, I'm going to short sell WTI again and partial profit take on silver. That's really that thing. So when we go into resistance territory in WTI, I sell this one, partial profit take on this one, and the opposite works as well. When it comes to stocks, though, like I said, be very cautious. A lot of volatility could be surrounded within the next few months, but I still expect the same thing. Some stocks will take a hard hit, some others will recover, and we're going to get that same old K-shaped. Everyone's going to be volatile in the first days and weeks, but it's not going to take more than a couple of weeks in my humble owners, and I think that we're going to start seeing some trends emerging. Some oversold assets will start rebounding. Only those who have value, not too much debt and things like that. Forget about the crappy debt and shitty junk bonds. All of these things will not rebound. We're going to look for value now. So those who are oversold and have value will likely rebound, and they have hell of rebounds to make. Some stocks have like to double in order to retrace to the latest resistance. So there's some staggering gains that could be made on these stocks. And on the other hand, some overweighted and overpriced stock like Apple, Microsoft, Amazon still have some pain to come, in my humble honor. So it's going to be a mess for the stocks. Okay. So cryptos now. Well, what do we do with cryptos? Is it going to be easy? Yesterday's rebound was like 10% all across the board, and now today we got the minus 10%. So whatever the fuck is going, it's going to be volatile. Yes, and that was the plan all along. So understand it that way. As usual, just like I said, the K-shaped recovery that I forecasted in the stock market is exactly going to happen as well in the crypto market. It's going to be a shitty volatile thing in here because we are trading the mid part of that K, but out of the next few weeks, some trends will rapidly emerge. Like I said, the number one thing that I think is going to happen out of what the Fed has been doing yesterday is reducing volatility. It's not going to be immediate because the market is very much under huge tensions currently, and we can definitely see this. Yesterday was bullish, today we do exactly the opposite direction. So that's very much stupid. It's going to be volatile for the next few weeks, but I expect anyway the overall broad market volatility to shrink. Like the swings are going to reduce over time until the trends naturally emerge. The good assets will go to the upside, the bad assets will go to the downside, pure and simply, and that's the fucking K-shape I've always wanted. I never thought we would definitely be waiting for the Fed to give us kind of a roadmap to eventually trigger this, but that is now my new motive. Until further notice and until proven wrong, either because just an external factor fucked it all up or just for some reasons, the market is now going wild. Now that the Fed says you're right aligned, the market could try to go absolutely nuts. So that's a possibility, but I don't estimate this as being the likeliest probability. I think the likeliest probability is a bit of short-term volatility because people have been trading leverage yesterday for stupid reasons, okay? So your stop losses below that low, absolutely not safe. Gonna be a bit of stupid noise, okay? But expect that noise to shrink very quickly, and then the trends will emerge, okay? And this is what's always been the case for me into the K-shaped recovery. Expect a lot of noise in the early stages, but when these things will normalize, you will see the trends emerging. And when these trends starts to emerge, there will definitely be a K-shaped directory, because lots of traders will start arbitraging the market by selling some shitty stuff to support the good ones. And this will further accentuate the reduced volatility on the good ones and the increased volatility and bearish direction on the shittiest assets. That's what I always wanted. The Fed seems to be finally giving us the clues that this is finally eventually going to put and make sense through prices. So this is the reason why I wanted to update this, because I think we're at the turning point of a big swing trade that is very likely going to last for the next 3 to 4 months, according to the Fed's expected action targets, in which I think the next move is going to be out of the next 3 months, when we'll terminate the most aggressive phase of the normalization and enter the next one, in which the balance sheet will be the major impactor. So if you understood the message, it's first about rate hikes, and we're going to go fast in these, and we're going to go slower with the balance sheet and with the least riskiest assets, and then we're going to take more risk with the balance sheet as we reduce the risks we take with interest rate hikes. And if you understand that, I think you understand the message that has been sent very clearly to every professional in the market now. So don't try to be dumb, and don't try to play the short-term volatility. Have some goddamn guts. Trade what you think is good, and most importantly, understand that whatever happens within the next few weeks can be noisy, but it will emerge trend as the volatility coming out of the aftermath of these interventions will probably slow down for the good assets. But some that are shitty will immediately get to break the supports that have tried to be built yesterday, and they will keep on pushing below. There is no room for everyone. Just like there are so many shitty stocks out there, there's so many shitty crypto projects that have been valued absolutely out of control. So these things will have to go down. But the valuable assets are there as well. Don't throw the baby out with the bath water. It's really what this is all about. But anyway, it's also important to understand that the Fed is no longer kicking the can down the road. They finally decided to act and come up with a market expectation, and that's the second real message that you need to come out of this Fed meeting. The market was right to go against the Fed, and the market has reached out to the current market's Fed expectation. So expect a bit of volatility, a bit of push up, push beyond kind of the market, but still also understand that the value is pretty much near the current market prices. If you trend trade on the assets that have been trending already, you don't get the message. The message is we're already nearing the target. Okay, so that means range is the likeliest outcome on the assets that have been trending recently and trending hard, like the euro dollar, the yields. We're pretty much going to slow down the pace, probably keep maintaining the current pressure, so still slightly bearish tainted on the euro dollar, slightly bullish tainted on the yields, but we're pretty much nearing the arrival territory rather than the beginning of something. So those who will trend trade those assets will have a lot of troubles, in my humble honor. So wait for the market to neutralize these things and trade the according ranges. And for the rest of the market, try to understand that those who have no trends, that have been piling up all the hesitation until this day and started from the 1st of fucking January, in which we said this year will be hard to navigate. I think now we finally have clues that the fucking K-shaped recovery that was my plan all along is finally going to start diverging the K. These divergence that I was willing to get, these, not divergence, not the right word, decoupling is the word that I wanted. I think it's time now that the interest rates are going to hike very quickly, that we start depreciating the shit and appreciating the value. It's right about time that we go for this K-shaped dichotomy. It's about time, and I think yesterday's Fed meeting, who has been very well handled in terms of communication, has clearly sent the message. Might take a few weeks to work around the volatile shit, but value will emerge. I have very good confidence with this. So I will wait, of course, to get and to see the price confirmation. I want to see the volatility, even though it increases in the short run, I want to see it reduced, and then I want to see trends starting to emerge. I don't think trends, okay, like I said, I think bullish range. In terms of actual targets, I think value targets for Ethereum would be retracing to the upper part of the range, retesting the previous all-time highs around $450 billion and $80 billion. So I think this is where we're headed. Like we said, it's probably going to take 3 to 4 months to get there. So don't expect these things to surge crazy shits. Most importantly, if we have to take 2 to 3 weeks to calm down volatility in the mid area we're currently trading, we're in the mid range. Okay, so this can be noisy out there. So expect that if we take 3 months to stabilize volatility, that leaves us with 2.5 months to actually get up, and there's not that much money to make. So if you expect surging things like that, it's not going to happen. Don't expect recovers like that. It's going to be volatile first, and then the volatility will shrink and shrink as we get closer to the target with reduced volatility. Okay, same thing for Bitcoin and my Euro target. I still target the same level. Same thing for Atom, same thing for the links, or whatever. This is my game. I don't say that I'm going to be 100% right with the ones that I've chosen, but once again, choose value. Don't forget the speculative calls. This is no longer the play. It's not going to play out anymore. There is going to be a K-shape. Some assets will do, some assets won't. And you're going to have to wait for a few weeks until you can actually differentiate the two. So I will, of course, adjust as I get the early validations and stuff like that. I also want to see the sentiment, even though it's going to be short-term volatile, I want to see it neutralizing itself within the next few days. Okay, guys, I think we got it all. So thank you for listening. It was a long one, but I hope you finally got the message that the Fed has sent today. Might be volatile, but it should shrink, and we're finally going to get the K-shaped recovery I wanted. And it's worth as well for stocks that I think it's going to be for cryptos. So don't get it about the stupid correlation study or whatever that is. It's not going to happen. It's going to be volatile now, and we're going to get that decoupling because the K-shaped recovery needs it. That's it. Bye, guys.